I manage over $50 million, and here's what I wish I knew before my first angel investment. Hi, I'm Rupa Popat, the founder and managing partner of Arāya Ventures and the House of Arāya. I manage over $50 million in venture capital funds. I'm backed by the British Business Bank, and I've co-invested alongside over 100 VC funds, including some of the world's best. But when I made my first angel investment, there was a lot I didn't know, and no one really tells you how this world actually works until you're already in it. So in this video, I'm going to share 3 lessons I wish I knew when I started. And the third lesson is the one that surprises everyone because it's not about the deal at all. So let's start with the first thing that caught me off guard. Lesson number 1, the portfolio construction gap. It's a mistake I see all the time. When I made my first angel investment, it was the only deal I had looked at. I spent time on it, I built conviction, and actually I exited it successfully. But what I didn't have was a strategy. So what happened next? I made my second, third, fourth, fifth investment very quickly in succession. Not because they were part of a plan, but because I was reacting to opportunities. And that's how most angel investors invest. Emotion by emotion, and usually not enough investments. For example, my friend or my cousin is launching a business and let's back it, and without a clear portfolio approach. But venture doesn't work deal by deal. It works at the portfolio level because of one of the most fundamental truths. That is the power law. A small number of your investments will drive the vast majority of your returns, which means that most of your angel investments won't matter financially, a few will perform well, and 1 or 2 will carry everything. And so if that's the game, then the question isn't only, is this a good deal? It's also, how does this fit in to my portfolio? Now, I think about investing very differently. Before I invest, I ask, how many investments am I going to make? At what stage am I focusing? How concentrated or diversified do I want to be? And what does winning actually look like across this portfolio? Because without that, you're not really building a portfolio, you're just collecting companies. Lesson number 2, a great company is not always a great investment. These are 2 completely different decisions, and most people treat them as the same thing. You see a company, and you think the product is great, the founder is impressive, and the traction looks strong, and so you invest. But those aren't the only questions you should be asking. You're also asking, is this a great company? Is this a great investment at this price, on these terms, right now? A company can be amazing, but if the valuation is too high, the cap table is messy, or if your ownership is too small, it can still be a bad investment for your portfolio. You can be right, but still not make money. You don't get paid for being right. You get paid for owning enough when you are. Now, I separate this into 2 clear evaluations. First of all, is this a great company? Asking, is this solving a real problem? Is the founder exceptional? Is there a genuine momentum in this company? And then I also ask, is this a great investment? What valuation am I entering at? What ownership will I have? Is the cap table clean? Does the founder have enough equity? And what has to happen for this to return my portfolio? Because venture returns are not only driven by good companies, they're driven by investment discipline. What matters is your entry price, your ownership level, and being able to design those outcomes. I've seen and passed on companies that were clearly strong, but at a valuation where the upside just didn't make sense, or where the founder had already diluted a lot of their equity, and as such, it was still too early for them to have done so. And that discipline matters more over time than getting into every great deal. So now every time I look at a deal, I separate the 2, and it completely changes how I invest. Lesson number 3, the isolation cost. This brings me to the third lesson, and the one I mentioned at the start, the one that has nothing to do with the deal itself. When I first started angel investing, it was solo. I was making decisions on my own with limited data and no real feedback loop. And that can be incredibly expensive because what I didn't have is a second opinion, a benchmark for what good looks like, or visibility into how other investors were thinking. So every mistake you learn slowly and alone. Compare that to the investors who are embedded in strong networks where they have deals that are discussed, challenged, debated. Their learning curve compresses dramatically. They see what experienced investors focus on, what questions they ask, and what they pass on and why. The biggest edge in angel investing isn't just access to deals, it's access to how other people are thinking about it too. The gap between investors operating in isolation and those embedded in strong communities isn't small. It compounds over time. For me, this was one of the biggest shifts. moving from making decisions alone to being in environments where ideas are challenged, thinking is sharpened, and group due diligence changed the game for me. Because venture isn't just about picking companies, it's about how you make decisions, how quickly you learn, and who you're learning alongside. And once you see that, you start to realize the environment you invest in is just as important as the companies you invest in. If this made you think differently about how you invest, subscribe. Because next week, I'm going to show you the UK tax structure that makes a £20,000 investment actually cost you £10,000. Most people have no idea this exists, and once you see the numbers, it changes how you think about investment. Everything I cover on this channel, the investment patterns I'm watching, the thinking behind how I invest, and what our fund is actually seeing in deal flow, I distill into a 5-minute newsletter every Tuesday morning called Arāya Signal. One insight, no filter, completely free. The link is in the description below and it's pinned in the comments. And if you're serious about investing better, it's worth 5 minutes of your time every Tuesday. Subscribe.